Every market cycle has a bubble. The question isn't whether AI is one, it's who will survive when it bursts. You hear it everywhere. This feels just like .com, AI stocks are massively overvalued, and this will end badly. And to be clear, these concerns are not irrational, but here's the problem. When you actually look at the data, the AI bubble narrative starts to fall apart. Today, I want to explain why we are not in an AI bubble yet, why concentration risk is being mistaken for speculation, and why the strongest counter-argument, circular funding, is real but often misunderstood. I'm Edward Kaalstien, founder of Egg Capital, where we empower your investing journey. If you find this kind of long-term, fundamentals-based thinking useful, please consider a like and subscribe. It helps the channel grow and tells YouTube to show you more content like this. Now let's break this down properly. To call something a true market bubble, three things usually have to be present: extreme valuations, weak or non-existent earnings, and capital chasing hype instead of cash flow. Let's start with valuations. Today, the technology-heavy portion of the S&P 500 trades at roughly a 30 times price-to-earnings multiple. That sounds expensive until you add historical context. At the peak of the .com bubble, tech stocks traded above 50 times earnings, and many of those companies didn't have profits at all. Today's AI leaders, Microsoft, Nvidia, Alphabet, and Meta, are not speculative startups. They are among the most profitable companies in corporate history, generating enormous free cash flow. This alone puts today's market in a very different category from 1999. So why does this still feel like a bubble? Because expectations are massive. AI is being described as a productivity revolution, a labor disruptor, and a multi-trillion-dollar opportunity. And that kind of narrative naturally creates discomfort. But expectations don't create bubbles. Detachment from fundamentals does. AI spending today is driven by enterprise adoption, cloud infrastructure demand, and finally cost reduction and efficiency gains. Companies adopt AI not for branding or hype, but because it fundamentally improves the profitability of their core business. A 30x multiple for companies growing earnings at double-digit rates with dominant platforms and pricing power is ambitious but not irrational. Now let's address the most serious critique. The circular funding argument goes like this. Big tech funds AI startups. Many of those startups are loss-making. They then spend billions on cloud services and GPUs provided by the same firms that funded them. Microsoft funds OpenAI. OpenAI spends heavily on Azure, and Nvidia invests across the AI ecosystem while selling chips to nearly everyone involved. On the surface, this looks like capital moving in a loop, inflating revenues without real end market validation. And it's important to be honest here. Yes, many AI startups are currently unprofitable. That matters. But losses alone do not define a bubble. What's happening here is better understood as strategic pre-investment, not speculative access. Microsoft isn't funding OpenAI to juice near-term revenue. It's doing it to secure long-term control over the AI stack, models, distribution, enterprise adoption, and cloud workloads. Nvidia's investments work the same way. They are not betting on which startup wins. They are betting that AI compute demand explodes regardless of who wins. This capital isn't chasing hype. It's pulling forward infrastructure build-out for a technology that already has real enterprise demand, just immature monetization. That said, this is where the risk lives. Circular funding becomes dangerous if AI adoption stalls, enterprise spending fails to scale, model performance improvements slow while costs stay high, or capital markets stop subsidizing infrastructure before demand fully materializes. In that scenario, revenues would prove temporary rather than durable. We are not there yet. But this is the fault line investors should be watching. Now let's talk about the risk most people get wrong. Roughly 40% of all capital invested in the S&P 500 flows into a small group of large tech companies. That is not a valuation bubble, that is concentration risk. It means index performance depends on a handful of firms. Passive investing amplifies both upside and downside, and any regulatory, earnings, or macro shock hits harder. This doesn't mean these companies are overvalued. It means the market is less diversified than it appears. Those are very different problems. So are we in an AI bubble? In my view, no, not yet. Valuations are elevated but supported by profits. Capital is concentrated but not speculative. The real risk isn't collapse, it's expectations outrunning execution. Bubbles don't start with innovation. They start when fundamentals stop mattering. The real question investors should be asking isn't is this an AI bubble? It's which companies will actually turn AI into durable cash flows and which ones won't. And don't forget to like and subscribe.